Welcome back. In our top business story, the UAE cabinet approved a measure to liberalize the trade of 12 essential food commodities to fight, quote, unjustified price rises and encourage competition in the local market. This step will contribute to market stability and strengthen customer rights, Sultan bin Zayed Al Mansouri, the UAE Minister of Economy, said. The 12 items that are being liberalized include livestock and dairy products, fats and oils, honey, eggs and fruit juices, among other things, Al Mansouri said. He added the decision will boost the UAE economy's competitiveness by curbing monopoly practices and will ensure the timely supply of goods and services. UAE Central Bank Governor Sultan bin Nasser Al Suwaidi expects an inflation rate of about 2% this year. He told a Bloomberg reporter in Muscat today that the sources of inflation in the Emirates are under control, as real estate prices and rents are stable. Both account for approximately 40% of the inflation basket. The IMF too forecasts only moderate price rises in the UAE. It expects an annual average inflation rate of 2.5% this year, according to its World Economic Outlook published in September. Last year, consumer prices on average rose 0.2%, according to the National Bureau of Statistics. The UAE's Islamic banking sector represented one-third of the global Islamic banking industry in 2011, according to a report by Oxford Business Group in collaboration with Abu Dhabi Islamic Bank. According to the CEO of Abu Dhabi Islamic Bank, Tirad Mahmoud, the global Islamic banking industry is currently valued at more than $1 trillion. Demand for Sharia-compliant financial products is growing fast due to the industry's emphasis on ethical principles and transparency, he added. Given its large size, the Emirates Islamic banking sector also helps spur economic growth, as Islamic banks play a major role in financing infrastructure projects and residential properties. Markets in Dubai and Abu Dhabi were up today on speculation declines in the past month, prompted by concerns over Europe's debt crisis were overdone. With that, let's now look at the stock indices across the GCC. Today, EU finance ministers met in Brussels to discuss the extent of private sector involvement in the Greek debt restructuring. We earlier asked Gaurav Kashyap, head of DGCX trading at Al Pari Middle East DMCC, what his expectations are, how much loss private bondholders can bear, what level would put Athens' debt on a sustainable path, and how the market reacted to all this.
Well, Linda, today we see the first meeting between European finance ministers of 2012 when they converge in Brussels to continue thrashing out the Greek debt restructuring plan between, of course, the Greek government and the private sector and their involvement on a whole. We did see risk markets pick up in trading last week on the back of what seemed like positive developments with regards to the Greek debt restructuring plan. Unfortunately, those sentiments hit a bit of a snatch in Monday's trading session, as coupon rates and the maturity of these longer-term debts could not have been agreed to. So although we're not expecting any major concrete developments coming out of Brussels tonight, we will be gauging on the developments of the meetings and what type of progress they're able to achieve. A couple of things we'll be focusing on with regards to the outcome of these meetings is A, what type of haircuts will be implemented. You know, we did see the haircuts ballooning from 20% up to 50% at the end of last year. Now we're looking at a region of around 70% in the private sector, accepting haircuts of 70%. Also, a simple haircut will not do. We'll be watching at what type of terms and conditions there will be with regards to swapping the shorter-term bonds for longer-term bonds. Originally, they were looking at some bonds which would be between 15 to 20 years. This has now been picked up to around 30 years. And lastly, of course, we'll be watching the participation rate. They must have a participation rate of at least 80% to secure that second tranche of IMF bailout money.
Research in Motion replaced its two co-CEOs, the Canadian company said in a statement, handing the top job to an insider with 4 years at the struggling BlackBerry maker. Thorsten Heinz, a former Siemens executive, took over as CEO on Saturday, replacing Mike Lazaridis and Jim Balsillie. The two lead RIM for 2 decades, but now bound to investor pressure and resigned as co-CEOs, as the once pioneering technology company struggles against rivals Apple and Google. RIM's share price plummeted 75% last year as sales slumped, and the two CEOs drew investor criticism for releasing products without the features necessary to compete. However, it remains to be seen whether Heinz can accomplish the turnaround, analysts warned.